In the field of corporate finance, the financial manager occupies a central and strategic role that serves as the essential bridge between a company's internal operations and the external capital markets. To understand the magnitude of this position, one must first recognize that every action taken by a business has a financial dimension. The primary objective guiding a financial manager is the maximization of the firm's value, which is most accurately reflected in the market price of the company's common stock. This goal ensures that the interests of the shareholders, who are the ultimate owners of the firm, are prioritized. To achieve this objective, the financial manager must navigate a complex landscape of three primary types of decisions: investment decisions, financing decisions, and dividend decisions. Each of these pillars is interconnected, forming a cohesive strategy that determines the long-term health and growth potential of the organization. The first and arguably most critical responsibility is the investment decision, often referred to in academic circles as capital budgeting. This process involves determining which real assets the firm should acquire to generate future wealth. These assets can be tangible, such as machinery, factories, or real estate, or they can be intangible, such as patents, trademarks, or research and development initiatives. The fundamental principle underlying the investment decision is the comparison of the expected benefits of an asset against its costs. Because the benefits of an investment typically materialize over many years, the financial manager must account for the time value of money. This concept suggests that a dollar received today is worth more than a dollar received in the future due to its potential earning capacity. Consequently, the manager uses sophisticated tools to evaluate whether the projected cash inflows, when adjusted for their timing and risk, exceed the initial cash outlay. For instance, consider a major automotive manufacturer contemplating the development of a new line of electric vehicles. This investment decision requires years of research, the retooling of existing plants, and significant marketing expenditures. The financial manager must analyze whether the future sales from these vehicles will provide a return that justifies the enormous upfront capital commitment. If the projected return is higher than the firm's hurdle rate, which is the minimum acceptable rate of return based on the riskiness of the project, the investment is deemed value-creating. This decision-making process is not merely a one-time event, but a continuous cycle of allocating scarce resources to their most productive uses. In addition to long-term projects, the investment decision also encompasses the management of short-term assets, known as working capital management. This involves ensuring the firm has enough cash, inventory, and accounts receivable to meet its daily operational needs, without tying up excessive funds that could be better utilized elsewhere. Once the financial manager has identified which assets are worth pursuing, the focus shifts to the financing decision. This second pillar addresses the question of how the firm will raise the capital necessary to pay for its investments. The manager must choose between two primary sources of funds: debt and equity. Debt financing involves borrowing money from external lenders such as banks or bondholders with the promise to repay the principal along with interest. Equity financing involves raising capital by selling ownership stakes in the company, either through the issuance of new shares of stock or by reinvesting the profits that the company has earned over time. The combination of debt and equity used by a firm is known as its capital structure. The financial manager's challenge is to find an optimal capital structure that minimizes the firm's overall cost of capital while managing the associated risks. Debt is often seen as a double-edged sword. On one hand, interest payments on debt are typically tax-deductible, which can make borrowing a cheaper source of funds compared to equity. Furthermore, debt allows the original owners to maintain control of the company without diluting their ownership. On the other hand, debt introduces financial risk. Unlike dividends to shareholders, interest and principal payments to lenders are legal obligations that must be met regardless of the firm's profitability. If a company takes on too much debt and experiences a downturn in revenue, it faces the threat of insolvency or bankruptcy. In contrast, equity is safer because there is no legal requirement to pay dividends or return the capital to shareholders. However, equity investors demand a higher rate of return because they are the last in line to be paid if the company fails, making it a more expensive source of financing for the firm. A financial manager must therefore weigh the benefits of tax shields and lower costs against the perils of high leverage. For example, a stable utility company with predictable cash flows might comfortably carry a high level of debt, whereas a volatile technology startup might rely almost exclusively on equity to avoid the burden of fixed interest payments during its early years of growth. The third major responsibility of the financial manager is the dividend decision, which is sometimes called the appropriation or distribution decision. This involves deciding what to do with the net profits generated by the company's operations. After all expenses, taxes, and interest have been paid, the remaining earnings belong to the shareholders. The financial manager must determine how much of this profit should be paid out to the owners in the form of cash dividends and how much should be retained within the business for future reinvestment. This is a delicate balancing act that requires a deep understanding of investor preferences and the firm's growth opportunities. If the company has a wealth of highly profitable investment opportunities, it may be in the best interest of the shareholders for the firm to retain its earnings. By reinvesting those profits into new projects that earn a high return, the manager can increase the overall value of the firm, leading to capital gains for the shareholders in the form of a higher stock price. However, many investors, particularly those who rely on their portfolios for regular income, prefer receiving immediate cash dividends. This is often referred to as the bird in the hand theory, suggesting that a certain dividend today is more valuable to some than the uncertain promise of future growth. Furthermore, dividends serve as a powerful signaling mechanism to the market. A consistent or increasing dividend payment often signals to investors that the management is confident in the firm's future profitability. Conversely, a sudden cut in dividends can be interpreted as a sign of financial distress, often leading to a sharp decline in the stock price. The financial manager must also consider alternative ways to return value to shareholders, such as share repurchases, where the company buys back its own stock from the market. This reduces the number of shares outstanding and can increase the value of the remaining shares. The dividend decision is therefore not just about distributing cash. It is a strategic communication tool that reflects the firm's long-term prospects and its commitment to shareholder wealth. These three decisions, investment, financing, and dividend, do not exist in isolation. They are deeply intertwined and must be coordinated to ensure a consistent corporate strategy. For instance, the dividend decision is inherently linked to the financing decision. If a company decides to pay out a large portion of its earnings as dividends, it will have less internal cash available to fund new projects. This may force the firm to turn to the capital markets to issue new debt or equity, which in turn affects its capital structure and cost of capital. Similarly, the investment decision dictates the firm's need for financing. A company that decides to embark on a massive expansion phase will require significant capital, which might necessitate a reduction in dividends or an increase in borrowing. The financial manager must continuously monitor these trade-offs to maintain an equilibrium that supports sustainable growth. Beyond these three core decisions, the financial manager also plays a vital role in risk management and financial planning. The modern business environment is characterized by volatility in interest rates, exchange rates, and commodity prices. The financial manager must identify these risks and employ various strategies, such as hedging with derivative instruments, to protect the firm's cash flows and value. Financial planning involves creating detailed projections of future revenues, expenses, and capital requirements. By developing these forecasts, the manager can anticipate potential funding gaps and ensure that the firm always has access to the liquidity it needs to operate. This forward-looking perspective is essential for navigating economic cycles and responding to competitive pressures in the global marketplace. In summary, the responsibilities of the financial manager are broad, complex, and fundamental to the success of any enterprise. By carefully managing investment decisions, they ensure that the firm's capital is directed toward the most promising opportunities. Through prudent financing decisions, they secure the necessary funds at the lowest possible cost while maintaining a manageable level of risk. Finally, by making strategic dividend decisions, they balance the need for internal growth with the expectations of the shareholders. Each of these functions requires a disciplined approach, a firm grasp of economic principles, and a clear focus on the ultimate goal of maximizing the value of the firm. As an expert in this field, the financial manager acts as a guardian of the firm's resources and a strategist who shapes its future trajectory. Whether a company is a small local business or a massive multinational corporation, the quality of its financial management is often the determining factor in its ability to survive, compete, and flourish in an increasingly complex financial world. By mastering these three decision-making areas, the manager provides the structural integrity that allows the business to fulfill its mission and deliver lasting value to its stakeholders. This integrated approach to corporate finance ensures that the firm remains resilient in the face of uncertainty and prepared to seize the opportunities of tomorrow.